Welcome to the daily update, where I'll go over the action in the market for Friday, December 5th, and we'll see how things look for Monday, December 8th. It wasn't quite the big breakout day that was hoped for. The market seemed to like the core PCE that came out, and we were going up, looking pretty solid, and then we just kind of stopped and ended up coming back down and chopping along sideways and having a marginally higher day in Friday's session. So before I get into the video, I have a thing called the SPX Investing Program from now until the end of 2025. Feel free to check that out. It's free. All you have to provide is an email address. There's additional information that I post there. And one of the benefits is now that it's the weekend, I'll be preparing a number of weekly videos, and they're available right away, including the video each day where I delay them on YouTube and Rumble. So check that out. There's other information that you might find useful there. You can set up a time to talk with me if you would like, and just see if that's of interest and benefit to you. Okay, so right at the open, we had a higher open, and it looked like, okay, maybe we're going to have a little bit of a breakout here. We climbed above R1 at 68.73 and R2 at 68.90, but then a little bit above that, we just kind of fizzled out and just chopped along. And then we started to go back down. We declined back below R2, R1. We got almost all the way down to the unchanged level, which sometimes that can be, okay, we filled the gap and now let's get set to go higher in the afternoon. That didn't happen. And so we just chopped above and below R1. We closed slightly below R1 at the 68.70 level. Now, we had been dealing for the last few trading sessions with 68.60 being overhead resistance. So on the positive side, we did get above that. And we were up 0.19%, not all that much of a gain, and still below average with volume. And we're positive though, and we're trying to develop a trend now. It's not showing a lot of conviction, but in the short and intermediate term, we're trying to cross above the moving average. But we continue to be positive on all three time frames, the short, intermediate, and long term. We base those around moving averages. And interest rates, we'll go through and look at that. We did see that climbing back up a little bit there, which is a little bit different over the last few trading sessions because the market's really anticipating that the Fed's going to cut rates next week. And what we've seen the last few times is rates tend to really go down, then the Fed cuts rates, and then interest rates go back up. We're seeing them kind of going back up before the fact this time. And then with all the geopolitical things going on, it's not really directly impacting the market right now. Okay, so the core PCE released, it had very little impact on rate cut hopes. The market's pretty much already figured that out, and so it didn't change it. And I'll go over this in the weekend video. We look at the Fed watch tool and say, what's the probability of a rate cut? And that really didn't change in Friday's session. It didn't become less, it didn't become more of a conviction. It's pretty much the same. And then I've been watching Netflix now for the last few, well, pretty much since their earnings came out. And it's really been drifting and they're starting to generate a downtrend. Well, now it was announced that they're making an agreement to buy Warner Brothers Discovery. And of course, they're going to need money to do that. And that takes away from their bottom line. And so maybe that's why the stock has been declining recently. And then growth continues to underperform value. We're doing okay. We're not falling apart, but it's not really taking that leadership role, which is the same thing that we've been seeing now for the last number of weeks. And we're still pretty optimistic that there's going to be a rate cut in the upcoming week. We still have a confirmed Hindenburg-Ullman that's in the background. Now, as I've been saying, the further we get away from that and no additional spikes, the less relevant that becomes, but it's still there, and we still just want to respect it and pay attention to it. But every day that goes by, it becomes less and less likely. But we're coming up to the end of the year. We're going to be starting a new year. That's quite often when new things can start, whether that will be an upward move or a downward move. And we still have an unconfirmed Zwag NYC breadth thrust, and it's probably not going to be confirmed. We had until Friday, December 5th, for that to be confirmed. And with the lethargic day that we saw, it's probably not going to be confirmed. But that's not necessarily negative. It would be more positive because now you have something, hey, we've got this confirmed here. But it's still been holding up fairly well anyway. And the fact that we were really going down, we had an extreme negative reading, and that we're coming up off of that and showing some positive action is still okay anyway. All right, and then no change here. We're seeing fairly good positive conviction here in the short term with the Stochc RSI, Williams percent R, and stochastics. These have been the same three charts that have been on here now for the last few trading sessions. And the CMB composite is still extreme negative, and we have a new one here. It's the advanced decline oscillator. And even though growth is not taking a real leadership role, we're seeing some of the rest of the market really improving, and that's getting picked up by the advanced decline oscillator. I'll show you that chart, and we are starting to get extreme there, but it could still go higher than where it's at right now. No change to the overall scenario. There was some hope that maybe with the core PCE finally coming out, and maybe it's because it was treated as old news that the market didn't really react to it with real conviction. But the markets and the Fed are still anticipating a soft landing, meaning no recession, and that the rate cut in December, it's pretty much a done deal according to the market. The dollar was down, interest rates were up. We're at 4.14% with the 10-year yield. And as I said, that's been coming up. The day before Thanksgiving, we were at 3.99%. So we've made a fairly big climb since then. And we are improving with sentiment, only up one notch here. We're at 40, where it's still negative, but we were coming up from 39. Now, again, when we had that big down day in November, we were down to 6. And so the context of this is that sentiment has been improving. And we're trying to start a trend here, both in the short and intermediate term. I'll show you those charts. With the slight update, where our bias is positive, and momentum is mixed to positive. And again, the reason why I'm keeping that as mixed is because we're not really seeing a lot of conviction, and we would like to see growth doing better when compared to value. Okay, so we got a number of economic reports here. Personal income, the headline number, came in up 0.4% as expected, and the same as last time. Spending, a little bit less than expected, up 0.3%. They thought it would be up 0.4%. Last time it was up 0.5%. Then prices up 0.3% as expected and what we saw before. This is the big one, the core PCE, lower than expected. And that's what produced that initial bounce up that we saw. Up 0.2%. They thought it would be up 0.3%. Last time it was up 0.2%. And then we're getting a number of different. We had a factory orders report yesterday, and now we're getting another one here. They thought it was going to be up 0.3% here, and so these reports are kind of all confused right now. Consumer sentiment, not all that great, but it is improving with 53.3, more than what was expected, or happier than what was expected, and also up from the prior reading of 51. Consumer credit, with the government shutdown, folks weren't getting paychecks there for a while, probably having to live off credit cards. Plus, now we're coming into the Christmas season where folks may need to use credit in order to have a nice Christmas. Was up 9.2 billion, less than the 9.8 billion that was expected, and last time it was up 11 billion. So here are some charts. Personal income and spending. Spending is going down a little bit. That's the blue line. Income is pretty much flat right now. And the year over year, it is ticking down a little bit, but we're still closer to that 3% level. And the Fed wants to get down to 2% with this. And it just doesn't seem to want to come down to that 2% level. But that doesn't necessarily seem to be changing the expectations that next week there'll be a rate cut. And month over month, seeing a drop off here in personal spending. Then here's another factory orders chart. I just showed another one here yesterday here, and slightly positive, but kind of ticking sideways year over year. And then year over year with the durable goods, we are going up with that. That's showing a little bit of strength. And then non-durable goods are pretty much flat right now and hanging out around the zero level. And then when you take out aircraft, it is going up here on a year over year basis. And then consumer credit, just kind of, it's still pretty high, but it's kind of leveling out here from on a year over year basis from what we were seeing before. And then the monthly change is up, but not up as much as what we saw in the previous month. Then consumer credit. So we're getting a little bit of a mixed picture here. We're trying to come back up with the blue line. That's how folks, that's the total reading. And then the purple line is how folks are feeling right now. So right now they're not so happy, but they seem to be more optimistic with the yellow line when it looks out into the future. This breaks down, this is that same chart, just shown in a little bit of a different way. And so it's actually going back up a little bit. And so that's a bit encouraging there. And then here's the chart that I show, also tracking with the 2-year yield and the 10-year yield is all, well, you can't see it here. Some of my charts are kind of displaying a little bit weird these days right now, but not as optimistic as we were in the past. But we did see a little bit of a tick up based on the other charts that we saw there. Okay, and then looking at the ISM Composite Index, and this is weighted here against recessions, really choppy lately, not really breaking down, but not showing an awful lot of strength either currently. And then this is a longer term chart. This is the 200-day simple moving average of the S&P. And what we've been concerned about is another chart that I'll bring up is that we're getting kind of far away from the 200-day simple moving average. And sometimes when we get too far away from that, the market will want to come back down closer to it. And then these are equity ETF flows where we are seeing a lot of money going into the market right now, which is helping to support things. And then the Goldman Sachs top down and consensus bottom up estimates. Okay, so the S&P still looking pretty good going out, whether you go top down, and that's more of a macro look. That's 7%. Bottom up, that's looking at all the companies one at a time. That's actually more optimistic. And then the other indexes that they track here as well. We focus mainly on the S&P. Then hyperscale capital expenditures, all this money going out here, they're still going to be spending a lot. And this breaks down the different companies and what they're projected to be spending. And that's part of the AI issue that's cropped up lately is that they're spending all this money. Are we going to get any return for that? And then what's going to happen with AI after they spend all this money? What are we going to end up with? And treasuries are having a pretty good year. Now, if you remember back to 2022, 2023, even 2024, it wasn't all that good. It was okay in 2023, but 2022 was terrible. I remember doing comparisons back to the 1700s, and it's like, okay, you have to go back that far to see how things are looking here. But holding up okay, and this bodes better for folks that have the 60-40 type of portfolio, 60% in stocks, 40% in bonds. Your 40% in bonds is doing pretty good this year in 2025. And then systematics, the wave of systematic selling has faded, according to Scott Rubner at Citadel. And volatility targeting strategies are starting to re-leverage after 2 weeks of non-steady, non-fin. Okay, blah, 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 blah. This is starting to turn back up after it had been coming down, and that could have been putting some pressure on the market. And then re-rating. It's now cheaper than it was at the end of October. 17 out of 25 industries are re-rating a lower forward PE ratio. Okay, well, yeah, if you want to pause this and look at it. But again, PE, it's good to know. I study it. I go over it in a weekly video. We keep an eye on it here, but I don't use it as a timing mechanism. And then I'll also be going over a chart similar to this. This is FactSet, and they're the big, they put out blog posts about earnings. So it's during the first 2 months of a typical quarter, analysts usually reduce earnings estimates because they're getting closer to now. And so they're like pie in the sky looking down the road. And then as it gets closer and closer, they have to be more realistic. We're seeing just the opposite of that. This was not the case in the third quarter, and which we finished now, and it's not the case in the current quarter, which now we're into the fourth quarter here. And so they're actually revising things up a little bit here. And that's encouraging for the market. All right, so here's the chart. Looked like we were off to the races right after the open. That's why I don't focus on the open. I focus on the close because we gave a lot of those gains back. We actually closed a little bit near where the open was here, but we gapped higher and then we quickly got above R1. It looked like, okay, here we go. We got above R2 and then just stalled right here. And then we saw some selling coming in, took us back down below R1, got above R1, and down below R1. Then we were breaking down here a little bit going into the close, but a nice little push up just to help us stay a little bit more positive. We never did go negative. We got close to the unchanged level here, but not quite at it. All right, and then pretty much flat. You can see over the last number of sessions how there have just not been a lot of conviction so far in December. See the big down move and then the up move, and then we're just kind of we're trailing higher, and that's why we're maintaining more of a positive stance. But there's really not an awful lot of conviction. And we're still seeing the red line above the blue line here with our intraday growth to value chart. They're both going up, even though this one's not doing as well. The blue line, we would like the blue line to be doing better than it is. And a little bit of an improvement here, but not a lot of conviction with the growth of value intraday chart for the S&P. So not falling apart, but not showing any real leadership either. So end of day growth was up where value was slightly lower. And then for the mid caps, growth was up less, and small caps, growth was down more. So they set an all-time high with the Russell 2000 on Thursday, and then there's some profit taking that came in on Friday. So this growth to value ratio is still looking pretty good when we look at the small caps here. Now this is the S&P 600, and we have a ways to go to get back to the all-time high with this particular index. And then there's the other small cap index, the Russell 2000. And here are the mid caps, still not looking all that great here with the growth to value ratio and not looking all that great with the S&P growth to value ratio. This has been one of the concerns and it's kind of keeping the market being lethargic right now, if not actually getting ready to turn defensive at some point. And not much of an improvement here. We're still at the high end of the rainbow. We're not falling apart, but we're not showing any conviction with this growth to value ratio. And just hanging out around the 50-day moving average with discretionary to staples and looking at that ratio. So trying to come up here a little bit in the short term, not an awful lot of conviction. We are positive with the short-term trend. The green line is above the red line. And we're trying to go up a little bit here with the intermediate term trend. It's also positive with the green line above the red line. And we still continue to be below average with volume, but this was the highest amount of volume that we saw in Friday's session. But every day this past week ended up being below average with volume. So looking good here though with the gamma exposure. We came up, we do have overhead resistance here at the 6,900 level. That's we're dealing with the 6875-ish level now. The whole chart is green. That's positive. If we do try to break up here, we still have a ways to go to get up to this 6950 level. And then if we start to decline, right now we're looking at support at 6800, which is a round number, and this is where strike prices are. So that wouldn't necessarily be a surprise. And we continue to be okay with the VIX. We're declining with the line chart and the bar chart. Also trailing off here with the volatility of the VIX as it's been coming down. We declined just a little bit here with this fear gauge, and we declined with this other fear gauge. So a little bit of fear coming out in Friday's session. We dropped off here with the daily equity put call ratio chart, and we are declining below this red line. Now, that means we're starting to get extreme here, but in this context, it's more positive when this ratio actually is declining. And then the 10-day chart is also declining, and that's a little bit longer term positive as well. And we continue to go up with the risk on to risk off ratio. We haven't surpassed this previous high here yet, but this is more positive when this ratio is going up. And we're just about back to the previous high here with the high beta to low beta ratio. That's positive as well. Not showing a lot of fear when we look at the volatility risk premium. We're still below the band. And we actually set a bit of a new high here. It's really hard to tell, but just barely based on volume. That's positive. And we were pretty much flat here with the advanced decline line based on price. But volume, that's kind of encouraging to see this breaking out. We had seen a new high based on price, but not on volume. Now we're starting to see a new all-time high based on volume and not quite confirmed yet based on price, which I tend to take more as a positive thing when volume is leading price. And we're still kind of chopping around here, but positive with the short and intermediate term advanced decline ratio. This is the advanced decline oscillator. This goes over the last 10 periods, and we're starting to get extreme here. This is positive in and of itself, and it could still go up from where it's at. But when we get above this red line, that's when we get a little bit concerned here. Now, other times when we had a really high reading, again, we really spiked up here. It didn't necessarily mean that we reversed, but we did slow down and then actually see a bit of a pullback. Then we had another pretty high reading in July. And again, it didn't necessarily mean a reverse. It just meant that we slowed down for a number of sessions after that. And we're looking pretty good here with the new highs, new lows, expanding new highs, a bit of a contraction or expansion of the new lows, but we're still going up with the 5-day chart and the 10-day chart. So internally, the S&P is still looking pretty good that way. We're positive with the accumulation distribution. We're just about on the moving average in the short term, but we haven't quite crossed below that. So it's positive in the short and longer term here. We're still positive with the check and money flow. The red line's going up, but now we're back to negative, getting a little choppy here with the chicken oscillator. We were positive. Now we came down and dropped below the moving average. So we're not seeing confirmation across all three of our smart money indicators. We are positive with the vortex. The green line's going up as the red line's going down. Haven't shown this in a while. This is longer term, a 10-day average of the highs and lows for the S&P. This is showing, and a lot of this is the week of Thanksgiving when we saw a really nice upward move here. That's getting picked up by this because, again, this is longer term. And when we get above this green line, that's showing a little bit longer term momentum. We're just not really seeing it right now based on price, but this is quite positive here. And we're holding up okay above the moving average, even though we declined here with the advanced decline line studies when looking at the NYSE common stock. Flat to a little bit higher here with the S&P, flat with the mid caps, who actually declined with the small caps, but still above the moving average. And declining here, but still above 50 with those stocks in the S&P above their 20-period moving average. A little bit of a tick down with the 50-period moving average study, a little bit of an improvement with the 100 moving average study and 200. So longer term, holding up a little bit better. We're seeing a little bit of a pullback with the shorter term moving averages that we follow. And still looking okay here. We've had a number of positive days, so we get green bars. We're just not seeing all that much. 0.11%, 0.19%. It's not really moving all that much. And we did pick up with volume, but we're still below average overall. And bit of a drop down here with the 20 moving average study, tick down slightly with the 50, and we're leveling out and still holding up okay with the 200 moving average study. And then the short-term conviction, we're still getting a high reading with the Stoke RSI and the Williams percent R. It's positive, but we're not getting an extreme reading with the CCI 14 or CCI 20 chart. We're rolling over a little bit with the short-term stochastic here, and that's extreme positive. We're extreme positive with the intermediate short term, and now we're starting to get extreme with the long short-term stochastic. So this is positive, but starting to look a little overextended. And we're positive with the force index and above the midpoint. We're above the 10, 20, and 30 moving averages. And as we've been staying above these lines, the green line is now starting to come above the orange and the blue line here, and that's positive. We see a bit more conviction when the green line is above all three, like we were seeing earlier on here in 2025. And we're still looking okay with the short-term trend based on 20 periods. The green line, blue line going up, prices above both. And we are 0.3% away from the all-time high on a closing basis for the S&P. So we have a 0.3% or more greater move in the upcoming week, like on Monday, then that would be a new all-time high. And we are more than 10% above the 200-day simple moving average. Again, we spent a lot of the summer months and then into the fall above this dash line, and it didn't lead to any kind of meaningful pullback here. I mean, we did have that move down here in November, but then that was 5.5%, and then we were able to bounce up from that. But we just want to be aware of this when we're above the dash line. It just means that we're a little overextended there. Positive and just barely into the +2 channel. And you can see here how we're really flattening out, where These Keltner bands, they were really moving up, and now they've just kind of flattened out overall. Intermediate term declined a little bit, but still positive with the balance of power. Still extreme with the CMB composite. That could suggest that we're overextended. But again, when we see real extreme readings like this, it doesn't always mean a reversal. It just might mean that we continue to be slow here. We are turning a little bit negative now with the lighter blue bars with the go, no go. Darker blue is positive. Lighter blue means, uh-oh, we're not quite as positive now. And we're still looking okay here with the highest high, lowest low value chart. TTM squeeze is still positive, lighter blue, and going up and positive. And really starting to drop off as some of these big days that we saw going down and then coming back up, they start to fall off the calculation for standard deviation. So it's no surprise that this is dropping. And we're actually turning a little bit positive here with the ease of movement. We're barely above zero again here after we'd spent quite a number of days below the zero level. And we're turning more positive with the Arun. It just was comatose there at the end of November into December, and then it just kind of kicked into gear where we are seeing the green line going up, that's buyers, and the red line coming down. The difference between the two is what the oscillator's measuring down below and holding up okay, but declining a little bit here with the S&P McClellan oscillator, but we're still above zero. So we're still going up with the summation index based on price and volume, declining, but still above zero with the NYSE McClellan oscillator. So we're still going up based on price and volume for the summation index on the NYSE. This has been negative pretty much the last week. Swell trading oscillator continues to decline based on price and volume. Going down a little bit faster based on price, not quite as much of a decline based on volume. That could be somewhat, excuse me, somewhat positive if volume is actually lagging when we're going down. But momentum is now positive across the board here. We were able to hold on to recent gains, and so the PMO is positive. We're positive based on price and volume. Ticking down, but still above 50 with the PMOs that are rising. Starting to roll over a bit with the buy signals, but still slightly going up with the PMOs above zero. Positive with the Elders Impulse System. Positive with the Parabolic SAR. Then here's the short-term oscillator. The slope, we're crossing above the midpoint, above the moving average. That's positive. MACD, above the midpoint, above the moving average. That's positive. So short and intermediate term, all of them are positive, and now we're starting to finally cross back over and look positive with the Trix and KST, which are two longer term momentum oscillators. Positive with the Copic curve, not quite extreme, but still looking positive with the Sean trend meter, above 50 with the money flow, declining, but still above 50 with the ultimate oscillator, setting another new all-time high with on-balance volume, still above 50 with the intermediate and short-term RSI. And we actually ticked down a bit here with the bullish percent index for the S&P, but we haven't crossed back below the moving average. We continue to go up with the bullish percent index for the NYSE and the NASDAQ 100. Intermediate term trend, we're still above both lines. The blue line and the red line continue to go up. We're still above all the plotted moving averages, and we're working off of a Pring bottom fisher buy signal now. But again, I wouldn't use this independently, but when it's producing a buy signal, I show it here in the videos. And then we were up 0.31% on the week. Not a gangbuster week, but it was an up week after all. And still looking okay here with the Heiken Ashi. The trend there is still intact. We're positive with the Keiki chart, positive with the Renko chart, positive with the three-line break chart. Longer term, just kind of chopping around, but trying to improve here a little bit with the 200 moving average study. And we ticked down just a little bit with the 150 moving average study. This is the ZWAG NYC breadth thrust. Now, it won't be updated until after Monday because there's a one-day lag here. But we didn't have enough of an upward move in Friday's session. Who knows? That's why we wait for this to actually be confirmed. But this is still okay. Now, it would be even better if this was when we were coming up out of the April lows. We were just all the way going down here and then immediately thrust up out of that, and you can see what the S&P did after that. Then we had another extreme negative reading in October, but we didn't get the confirmation for the actual signal. Now we had another downward move on November 20th, and we'll see if this still leads to positive price action going forward. And this shows we're not quite there yet, but this gives you statistics of how the SWAG NYC breadth thrust has performed compared to the averages of the market overall. This also suggests that even when we're close to a SWAG NYC breadth thrust, the further out you go, the better it looks going off into the future. Still positive on all time frames across all the indexes. Haven't seen any changes here. Negative with bonds in the short term, negative with the dollar in the short term, still negative in the long term with the US dollar index. So we had communication, which is a big growth area. It actually led things and it helped keep the market together in Friday's session, and that's encouraging. And then we had tech in second place and discretionary in third. These are the three big growth areas, but we need to see more than just one day here, one day there. We need to see more follow through with this, where utilities, healthcare, energy, these are the more defensive areas. They ended up being down the most, at least the bottom of the list. So it's kind of interesting. Even though we had that gap higher, we saw some negative alerts being triggered right at the open, with the utilities setting a 4-year low. That's interesting. Tech setting a 2-year low, materials a 4-year low, and energy a 3-year low. It's like, gee, why even open up your computer? Discretionary 4-year low. All right. Then the Nasdaq finally showed a little bit of improvement here, got above 23.6. We got above 48,000 again with the Dow. We didn't close there, but we got above it at least at the start of the day. Canada setting a new all-time high, and then we had a BPI cross below 50 with industrials and a BPI cross below 70 with utilities. And that was a little later in the day. So you can see here, we're in communication. You had both Google stocks up, Meta was up. That tends to bode well. Netflix was down here. But then we look at tech, and we saw marginal losses here with Nvidia and Apple, where Microsoft was up. Broadcom was up. That was one of the stronger areas in Friday's session. And then healthcare seeing a little bit more profit taking here, a lot of red in that area right now. And so the Dow was up 0.22%, not back to the all-time high, but it did close back down below 48,000. And we're still positive though with the Elder's Impulse system for the Dow. And you notice this, we closed well off of the high here with all the indexes. The Nasdaq was up 0.3%, still looking okay overall and positive with the Elder's Impulse system. Closing well off of the high here with the Nasdaq 100, but still looking okay overall. Positive with the Elder's Impulse system. Momentum for the Nasdaq 100 continues to be positive. And then we saw a little bit of a move down here. See how we're coming back to these previous highs, which was also a previous high kind of around this same area with the S&P 600 small caps. But is this going to produce some kind of problem here? Is this we come up and look better with the small caps and then kind of fizzle out? We'll see if that develops this time. And also kind of coming back to previous highs here with the Russell 2000, where it did set a closing high on Thursday, but then we were down 0.42% on Friday. And switching over to neutral with the Elder's Impulse system, and virtually unchanged, slightly higher with the mid caps, and neutral with the Elder's Impulse system. And just kind of drifting higher here, but well off of the highs with the Wilshire 5000 and well off of the highs with the total US stock ETF there. Just kind of drifting along above the 50-day moving average with the FANG index, the really big stocks. So we were down a little over 0.2% with Apple, virtually unchanged to slightly higher with Amazon dealing with its 50-day moving average. And Microsoft bouncing off of its 200-day moving average was up 0.48%. And Google, one of the stronger stocks here, up over 1%, not back to an all-time high though. And then Meta we're starting to see a potential death cross here, and it's still dealing with its 50 and 200-day moving average, even though it was up 1.8%, still below the 50-day moving average with Nvidia and down another 0.5%, and virtually unchanged to slightly higher with Tesla. Then here's Netflix, and maybe it could have been, we tend to see price action before news quite often. And this could have been why Netflix was drifting lower because they're going to be spending all this money to buy Paramount Discovery. And we're starting to see a death cross here. But it's seen as positive when you have companies taking over other companies. They tend to do that in a positive environment. And then we're still above the 50-day moving average, up over 0.5% with the Dow Jones Semiconductor Index, and we were up 0.78%. not back to the all-time high with the SMH semiconductor ETF, but we are more than 100% above the 200-day moving average with the weekly chart of the semiconductor index. That's when we don't necessarily predict that this is going to immediately go down. This just suggests that we could be overextended. And we're still declining here. This is positive. When the staples to tech ratio is going down, that means staples are underperforming, and that's good for the market. And we're going back up here. We're getting into the 60 range with oil, and we're still kind of in the high 98 range here. We were trying to get up into the 99 range with the US dollar index, but we're still below that 100 level, and that the dollar decline could be helping stocks as of late. And we're going back up here, but we're back to where we've been before with the 10-year yield. And we're still above the 50-day moving average on a closing basis with the 10-year based on price. And doing okay here with the Qs to S&P ratio, a little bit above the moving average with discretionary to S&P. And we're still under the moving average when we compare large cap growth to large cap value. And so we're back up to a declining moving average with the large caps, still under a declining moving average with the mid caps, and still looking pretty good here, although we fell back a little bit with the large cap growth to value ratio. And we're still declining here with the staples to S&P ratio. When that's declining, that's more positive for the market. And then we still have this Hindenburg almond here. So we just want to be aware of that. All right, so our outlook, we're still positive on all three time frames, and I didn't update this. So I'll go to the next chart here, and then any geopolitical things that may develop over the weekend. Here is the calendar for the upcoming week, and we're not going to have any economic reports on Monday. So that previous slide should have been blank there. But we're going to get some employment data, productivity and unit labor costs, JOLTS job openings. And then the big thing is going to be Wednesday when the Fed makes their announcement and then has the press conference after that. We'll get PPI on Thursday in addition to initial and continuing claims. And then we're not going to have any economic reports on Friday. I thought they announced that the employment report was coming out, but apparently, according to the calendar I saw, it's not. So this is still trying to get itself back into a phase of being organized here. And let's see, they also don't have it on this chart as far as when the employment report's going to be coming out. Now, seasonality for December 8th, even though that's the anniversary of when John Lennon was assassinated, it is positive for the Dow, S&P, and NASDAQ. So that looks pretty good from a historical perspective going back to 2002. And we do see, but when we just look at this based on post-election, there's a little bit of a drop off, and we see a little bit of weakness going into the next week. And then it's more later in the month when we tend to see more positive seasonality, at least according to that chart, where the first half does okay. It's the second half that typically does better. This also shows how December is typically positive. Later in the month is when it turns more positive. And then we had a down December in 2024. And so this chart is anticipating that it's not as likely that we'll have a down December in 2025. Positive seasonality here, positive seasonality here, positive seasonality here, and positive seasonality here. And then another new chart. It says the slingshot says don't sleep on 20. Okay, I don't have no idea what that means. But what are the returns after being down greater than 15% year to date, which we were last spring, and comes back up double digits? It's pretty good looking forward. We saw a nice bounce out of those lows. I mean, everybody was totally sure that the market was just going to fall off a cliff. Well, it bounced up from that. Okay, so we're still leaning with some negative stances here with the short-term growth to value ratio and discretionary to staples. Swelling trading oscillator continues to decline, and we have that Hindenburg almond, but the list is pretty short here. And now we are negative with the Chaikin oscillator, but the other two smart money indicators are still positive. Longer term, we're still hanging on to uptrends with growth to value and discretionary to staples. Ease of movement is back on the positive side, and we're still looking okay here with the McClellan oscillator and summation index, both for the S&P and NYSE. Momentum is pretty much now turning positive across all three time frames. Parabolic SAR is positive, as are the bullish percent indexes across the number of different indexes, even though we declined with the S&P. The money flow is positive. The ultimate oscillator, even though it declined, it's still above 50. The vortex is positive. The momentum for the NASDAQ 100 is positive. And we're just the financial sector just continues to underperform overall, even when it has a good day. And then I'll be hitting these over the weekend, the long-term special K daily and weekly charts. They continue to be positive. And we do have a praying bottom Fisher buy signal. All right, and then here are the pivot points. They've already been posted on the YouTube community tab. They're also available on the website that I have. And then our conclusion has not changed other than we're trying. I'm still keeping this as non-trending because it's just not showing a lot of conviction here. But we are crossing a little bit above the moving average in the short and intermediate term. But we need to see some follow through here. But we continue to be positive on all three time frames, and we're more than 10% above the 200-day simple moving average. Thank you. Have a wonderful weekend, and I will talk to you in the next video.